Another day, another new all-time high. Following on the surface, better than expected retail sales and initial jobless claims. But when you look under the surface of these numbers, retail sales actually plummeted -7% month over month. And this was the largest seasonal adjustment for the month of September we have ever seen, leaving some to speculate that maybe the number was not as strong as it looks. Neither here or there, markets are at least for now taking this and running with it. After all, what's new? We've seen a lot of weird data points and weird seasonal adjustments and revisions and this and that, and markets just take the headline number for what it is and go with it. With that said, Netflix will be reporting after the bell, and this will be the next big catalyst for markets to push things either higher or start a more rocky period. I think the big question is, when it comes to Netflix, is the consumer pulling back on streaming? The consumer has pulled back in a lot of different areas, and we've seen that on company earnings reports. Take a look at Nike, take a look at anything that really is discretionary in nature. People are cutting back on. Question is, are people cutting back on Netflix or not? In which I did take the liberty of doing some research on Google Trends. Take this for what it is, but there is a notable downtrend in the term Netflix sign up on, again, Google over the past 12 months. Now, this reported quarter is for the months of July, August, and September. And you can definitely see in parts of July, throughout August and September, an overall downward trend in sign-up searches. Does that mean that Netflix is going to miss on earnings? Here in the next couple of minutes we get reported. I don't necessarily think so, but it's not a super encouraging sign either. I will also point out that Netflix doesn't exactly have low expectations. Guggenheim raised their price target from $735 to $810 on October 11th. Oppenheimer adjusted their price target from $725 to $775. Morgan Stanley and that was on October 10th. Morgan Stanley adjusted their price target from $780 to $820 on October 10th. Deutsche Bank upgraded their price target from $590 to $650 on October 9th. And JP Morgan analysts raised their price target, or reiterated their price target, that is, of $750 on October 8th. So there's definitely some high expectations heading into this report. I would almost argue that analysts already know what the numbers are, considering the consensus is so bullish heading into this report. The question really is, does the stock go up or does it go down? Netflix is already sitting at an all-time high. The stock did sell off a bit today heading into this report. Nonetheless, today, as previously mentioned, the S&P 500 hit a new all-time high at $586.12 per share, really defying the seasonal bearishness that we get in markets around this time of the year, especially before an election. At this point, it's fair to say the bears are gone. They are in hibernation for the winter. Now here today, we did get the ECB that cut rates from 3.65% down to 3.4%. But really the main story was retail sales and initial jobless claims. Retail sales were expected at 0.3% month over month. You came in at 0.4%. So that actually beat expectations on face value, at least. Now, when you actually look under the surface, things were not nearly as great as expected. In July, you were at 726,000. This is millions, but we'll just call it that. In August, you went up to 736,000, but then in September, you plummeted to 681,000. So if you don't seasonally adjust these numbers, you actually fell 7% month over month for retail sales. Now, some individuals like Zero Hedge says that of course you had to get this large seasonal adjustment 3 weeks ahead of an election because you can't have a miss. Which honestly, I like to stay as apolitical as possible, but it does feel like the numbers are being severely misrepresented. After all, this was the biggest September seasonal adjustment on record. We've never seen anything like this before. And while you do normally get a large September seasonal adjustment, this was about double what you normally get in September, which would have caused us to have a negative number. You did also get initial jobless claims that came in at 241,000 today. The estimate was 260,000. Last week was revised up from 258,000 up to 260,000. Now, a lot of people on Wall Street are saying this data may not be that accurate because Columbus Day on Monday, maybe there was not enough time. Maybe that kind of delayed some of the reporting that we got from certain counties and certain states. Whether or not you believe that, I don't care. I don't think Wall Street even cares about initial jobless claims because of that fact. I think mainly it was about retail sales today because, again, we're all just saying initial jobless claims. It probably wasn't that accurate because of the Columbus Day holiday where there was really no data collecting being reported, and perhaps the day before or the day after there wasn't much data collection either. Hey, don't shoot the messenger. That's just what Wall Street is saying today. The real highlight, I think, is the Philadelphia Fed manufacturing data. This came in better than expected at 10.3. The estimate was 3. So that was great. Philly Fed business conditions soared from 15.8 to 36.7. That's a crazy increase. You had CapEx index that was at 25. It came in at 23.5. Philly Fed employment was one of the weak spots, coming in at negative 2.2. The estimate was 10.7. Philadelphia Fed new orders was negative 1.5 last month. It came in at 14.2 for this month. Philadelphia Fed prices paid was 34 last month. It came in at 29.7. So really, besides the employment component, there was nothing to not like in this Philadelphia Fed report. Now, in other news, specifically the Middle East, the Israeli army radio is reporting that Israel's Prime Minister Netanyahu will hold an urgent security consultation this evening with the participation of the Minister of Defense and the army commanders. Not exactly sure if that means we could see the retaliation strike against Iran tonight or not. We've kind of expected this for a while now, and it hasn't come, and it might just happen at the least most expected moment. We did have Fed Goolsbee that spoke today, but he did not comment on monetary policy or the economic outlook. Fundstrat's Mark Newton on X writes, small caps and transports break out while technology lags. This chart of DJ Transportation Average is also important and bullish for SPX when looking at the possible progression for stock indices between now and next summer. Tom Lee says everyone thought as core inflation tanked, earnings would fall under the weight of revenues falling off a cliff. But nope, core inflation did not reflect true inflation in the economy. S&P 500 revenue growth not correlated to inflation, and S&P 500 companies are outperforming inflation. And he says that real revenue growth is in fact surging. Renaissance Macro Research says, I'm not sure the claims data are as rosy as is being assumed. This does not look like it is just about hurricanes. NSA initial jobless claims excluding states impacted by recent hurricanes, Florida, Georgia, North Carolina, South Carolina, Tennessee, and Virginia, have generally been rising against last year. So if you look at that, it is pretty vertical, excluding the hurricane states. And being reported today, Chinese stocks enter a technical correction after falling more than 10% from the October 8th high. Dan Ives writes on X, TSMC monster numbers and guidance, very important data point for AI revolution thesis and growth looking ahead. As we said, ASML is background noise. TSMC is what matters for tech and the AI trade. And markets are judging that that is true, with Nvidia hitting a new all-time high today, up 2.7%. Other big tech names like Apple up 0.22%, Meta's up 0.63%, Google slightly down on the day today, but really not a big deal. Microsoft up 0.5%, and Amazon up 0.66%. Now, 10-year Treasury yields today are getting beaten up as far as the actual bond prices themselves. They are cratering. Yields are up to almost 4.10% today. If you're rounding, it would be 4.10%, technically 4.096%. You are up 8 basis points on the day today. This is the highest level you have hit since the Fed cut rates 50 basis points on September 18th. This is the highest 10-year Treasury yields have been since July 31st of this year. That is, as you would expect, weighing on the Russell 2000. The Russell 2000 is down 0.4% today. The Dow is up 0.38%, S&P up 0.35%, the Nasdaq up 0.57%, whereas the VIX is hitting 18.96. So seeing a little bit less fear out there with the VIX that's down 3.2% today. Oil is also falling about 5 cents today, but that's really nothing in terms of oil. I think everyone's kind of waiting for this retaliation strike against Iran and to see what happens to oil following that. CNN Fear and Greed Index currently sits at 73, so you're almost in extreme greed territory. Yesterday you were at 69. So this is quite a big jump just from yesterday. Market momentum is extreme greed, stock price strength, greed, stock price breadth, extreme greed, put and call options, extreme greed, market volatility, neutral, safe haven demand, extreme greed, and junk bond demand is greed. The most recent AI investor sentiment survey that came out yesterday shows bullish investors at 45.5%, neutral investors at 29.2%, and bearish investors at 25.4%. The percent of stocks trading above their 50-day moving average today is actually down about 3%. So 3% of stocks are breaking below their 50-day moving average from yesterday, currently sitting at about 67% of stocks above that 50-day moving average. GDP estimates are being revised upwards from 3.2% to 3.4% for Q3. And as you would expect via this on the surface better than expected data today, you are seeing the odds of a rate cut in November falling a little bit. You'd actually expect the odds to fall more, but you did go from a 12.8% chance of no cut down to, well, from 12.6% chance of no cut up to 12.8% chance of no cut. So you marginally moved in terms of what the markets are expecting in November. It's almost like the Fed's going to cut in November either way, and then December's more of a toss-up, 26.6% odds of no cut December. That is up from 18.5% yesterday, and then you're pricing out less rate cuts for 2025 with all of this good data that we are getting. Now, a lot of data has been questionable recently, so I put that in air quotes, but that's what's currently going on. But markets are still overall looking at November like it's almost a guarantee that we're going to get at least one more rate cut. Now, in terms of what happens to markets in the very near term, I think a lot of this does hinge on NVIDIA. Now, NVIDIA is one of those big tech names. They report first in the earnings season. They kind of guide the way for the rest of big tech. So if NVIDIA comes in with really good earnings, that's going to get the markets excited for the rest of big tech, which big tech, Mag 7, is the only area of the markets actually expected to have positive year-over-year earnings growth. The 493 other stocks in the markets on average are not expected to grow earnings this quarter compared to last year. Now, overall earnings expectations are only for about 4% growth in earnings year over year. So that includes big tech and the whole S&P 500. So earnings expectations for this quarter are not high at all compared to last quarter, which expectations were 11%. So you definitely have low expectations for the markets as a whole for this earnings season. But again, Netflix earnings expectations are on the high side, with analysts raising price targets leading into this. It does set you up for more of a chance of a disappointment following the report. But again, that is not a guarantee. So with that said, let me know what you think about all of this information down below in the comment section. If NVIDIA does have good earnings, that probably reignites the big tech trade yet again. You guys stay safe out there. I will see you in the next one.